Hello, today I will be telling you a few things that will help you minimize the risk in your stocks. So let us first begin with the things that must be taken into consideration first and foremost. Avoid the hype. Firstly, you must try to avoid following the hype that is present in the market at the point of buying shares. Most often in the stock market, you generally hear a lot about a company and this makes you want to trust the company, but it is very necessary to do analysis of a stock before putting your money into it. Secondly, you must also consider the fact that cheap isn't always good and expensive isn't always bad because the market is highly volatile and sometimes a stock is cheap because its business is growing less or actually it is slowing down, and at times it is cheap because it can grow faster, which means it is undervalued. Sometimes a stock is expensive because it's widely expected to grow its earnings or it may be just overvalued. Next, don't be surprised by the volatility in the market. Always look at the 52 weeks highs and lows for a stock that you are interested in to get some perspective on how widely the prices can swing within a year. Now let us come to what you should do to invest in the stock market. Now that depends on the path you want to follow. If you want to invest through a broker, then the first step is to join a broking firm that advises you on the top performing stocks in the market. This is the potential broking firm that you can join, and like you can see, these guys are mostly traders who have experience in handling the stocks. Furthermore, these websites provide you with the necessary analysis of data that you need to make a decision while investing in a stock. Now let us come back to the PPT. Now if you want to invest in your stocks alone, then you must have a clear knowledge and good knowledge of fundamental and technical analysis to decide whether a share is undervalued or overvalued. You must know the market and its sectors to predict the movements and also try to read all the articles and blogs posted on the broking websites. And you can see over here that Edelweiss also provides its articles under the page of Investology. You can read these to get an insight on fundamental and technical analysis of the stocks. Let us come back to the slides. Now we are on the section of what not to do. Firstly, don't buy on price alone. That is, do not assume a stock is bargain just because its price has dipped 10%. Make sure you understand why and how the price is going to rebound. It may even drop further and you may end up owning a penny stock in the worst case. Secondly, don't follow other people's investment plans. The money you make is yours. If you lose, then it was yours. You have your own goals for investment which differ from others in certain ways. Since the destination is different, there has to be different paths. Next, and the most important, don't forget to sell. You should have a plan for how much you want to earn through a stock, and you should have a criteria as to when you want to sell. Having a plan for selling will help you avoid selling out of panic over a short-term move in the market and making hasty decisions. Thank you and enjoy investing.